So we are going to look at ways that you can invest in stock, ways to invest in stock. One, make profits. Then two, manage stock loss risk. So today there is three tools we are going to explain today. Three tools we are going to explain that will help you do that. Number one tool is fundamental analysis. Then the second tool is technical analysis. Number three tool is portfolio management. Today we are going to look at the first one, which is fundamental analysis. Fundamental analysis, you can call it value analysis or financial statement interpretations. And what you use to do that is, the two tools that you use to do is ratio analysis and financial statement analysis. Fundamental analysis you make use of financial statement analysis. Then the second one is ratio analysis. So when we talk about fundamental analysis, it tries to use the information in the financial statement to know how the business is doing. For example, what is the turnover? What is the can the company make profit? What is the value of the business? So today we are going to take a practical example to see how we can use fundamental analysis in our financial statement analysis. So we are going to look at profit and loss account. Some people, when you talk about financial statement, we have a three statement that is very, very important. Number one is profit and loss account or income statement. Number two is balance sheet or statement of financial position. Then number three is cash flow statement. This first one deals about profitability of the business, how much the business making profit. This one talks about the value of the business, while the last talk about the cash health or liquidity of the business. How much cash, how are they able to fund their business and all the rest. So today we are going to take a practical approach to fundamental analysis. What are we talking about? We are talking about, let's see how a typical profit and income statement or profit and loss figure, P&L, we have ABC limited, they have P&L account or income statement. So the first, when we hear P&L account, some people, income statement, people think it looks so difficult. It's just a simple statement that shows the profitability of the business. One, it starts with the turnover. What is the sales turnover? It can be income, could be sales of the business. All of them is talking about the same thing. What did the business make? So we have the turnover as $1.5 million. Then we have our cost of sales. Sales or direct cost as $200,000. Then we have our gross profit as 1.3 million dollars. Then we have our administrative cost slash operational cost. Let's have 500,000. So this operational cost, administrative cost, you have something like rent. Inside it we have rent, electricity bill, salary, etc. All the operational costs. So we have our net profit before tax as 1.8 million, $800,000. Then we have our tax as $100,000. So the total, your difference will give us $700,000. So that's it. $700,000. So that's for the income statement. So the most important indices here we are taking up is turnover is $1.5 million. Then we have our profit before tax, after tax as $700,000. So these are the key indices we are working. So this is how the typical income statement look like. So let's see what the balance sheet look like. The balance sheet shows the value of the business. Help us to see the value of it, just as the income statement help us to see the profitability of the business. So what the income statement does? The balance sheet or the statement of financial position. So we have your fixed assets, or somebody call it non-current assets, non-fixed assets. So some of these fixed assets or non-current assets, we have building, we have something like $800,000. We have plant and machinery, $300,000. We have equipment. We have $400,000. We have motor vehicle, have $300,000. Then we have furniture, fittings, we have $50,000. So the total, we have as we have 700,000, 1 million, 1.850. So we have $1,850,000 as fixed assets. Then we have current assets. Current assets. We have accounts receivable, call it debtor. Receivable, we have it as $300,000. Then we have bank we have account receivable, we have bank. This account receivable is debtors or money that you expected to collect, convert to cash at the short term. So we have bank, you have $200,000 too. So let's say bank $500,000. So we have this, we have it as, let me move this thing, let's move okay, let's leave it here, $800,000. Then we have less current. Let's carry forward. This 800,000 should be here as the total current assets. Total current assets. So less current liabilities. So we have account payable. That's credit or people that you are owing. We have it as 200,000. So we have 300,000. So the total asset 800 minus will give you 800 minus 200,000 will give you 500,000. So the total asset, net asset will be 500,000, 1.8 million. That is total fixed asset, 850,000 plus 500,000. So which will give us we have 2.350,000. So 2.350,000. That's what the total net asset. So we have capital of the business, which is the same, which will be equal to 2.350,000. So that's how a typical statement of financial position or balance sheet look like. Have all these things. So we have it like this. So just you sum up your fixed assets. So if somebody should ask you what is the worth of this business, you see the worth of business. So we can use this thing as net assets. When you want to know the value of the business, you can use the assets. What does the asset worth? So the asset of the business, the net asset of the business, net assets here in this case, that's the current asset or the total asset. That's the total asset minus liability. So here in this case is 2.350,000. So this is 2,350,000. So the value of the business is all the totality of the assets minus any liability of the business. That will give you the net worth of the business. So that's it. So we have to look at the liquidity ratio. So this is where we are going to. So we are going to look at the ability of the business to be able to. We have seen the value, the worth of the business. We can as well use this financial statement to find out if the business will be able to pay back its debtors. Look at what the debtors look like. Account payable is what 300,000. While the bank have their bank, what is in the bank as 500,000. So that means the ratio of let me clean up this. The ratio of how will the company, like when you talk about leverage, let's use leverage ratio. That's ability of the business to be able to pay back. Ability of the business to repay its debt. And here in this case, we have the debt account payable as 300,000 payable, account payable, and the bank balance. So we have our account payable as 300,000 we have the bank at 500,000. So the bank can cover this up to twice. So that means they are still in order. So this ratio is should be close to 3. That's 3/5. 3/5. So 3/5 is still okay. So they can be able to pay back their debt since the 500,000 can cover 300,000 more than once. So which is still okay. So with this leverage ratio, we are going to look at the other financial instruments, how to analyze the financial statement in our next lesson. That will help you to be able to know whether the company is worth investing on. And after that class, we are going to look at technical analysis, and the last one should be portfolio analysis. How do you manage the risk? So I will await you in the next class to come to our YouTube channel to see how you can do that. Thank you for listening to us.